What's up, guys? Welcome back to Everyday Money. This is a video that comes straight from your all's questions in the comments. This one is going to be about capital gains. So be sure to smash that like button for me and we will get talking about what makes capital gains awesome and why you want to find a lot of your income being taxed at capital gains rates. All right, so capital gains taxes can be a little bit confusing, mostly because a lot of people aren't familiar with what they are, what is taxed at capital gains, because a lot of times people don't have assets that are taxed on a capital gains rate. For example, things like your 401ks are tax deferred until you take them out, so you're not seeing these capital gains taxes because everything gets to grow in there tax-free. What the deal is capital gains are taxes that you pay on the increase in value of an asset, being it a stock or if you get a dividends or whatever. Those are taxed at capital gains rates when you sell them. Now, dividends, as they're paid out annually, those are also taxed annually, and depending on if they're qualified or non-qualified, they will be taxed at capital gains rates of either short or long-term capital gains, and we are going to get into what those short and long-term rates are. So short and long-term capital gains, everything revolves around an annual basis. If you hold something for longer than 1 year, you get to enjoy long-term capital gains rates. If you hold something for less than a year, you are stuck with ordinary income rates. And these are your typical tax brackets that most people talk about for their taxes that they pay on their ordinary income. Those range from 10 to 37% depending on which your income level is, and each one of those is progressive. So it's not as if you hit a certain dollar amount and all the dollars that you made prior to that are taxed at that rate. But basically, you are taxed at, for example, 10% from zero to about $10,000, then you're taxed at another percent from another swath of money and another percent from another one. So in the end, after all of these tax levels are combined in your deductions and everything, you end up with an effective tax rate that is somewhere between the minimum amount and the maximum amount. Now, the maximum tax rate right now in 2021 is 37%. And this entire video is going to be based on people that's tax status is married filing jointly, because that is what mine is. That's what I'm most familiar with. It's very easy to find out what single tax rates are, what married filing separately, head of household is on the internet. Just Google whatever it is that you need. But for married filing jointly, anything that's $628,301 or more is taxed at 37%. This is where capital gains comes into play, and this is why the wealthy hold a lot of their money in assets that are subject to the taxable gains rates. Because if you are taxed at long-term capital gains rates, those are very favorable for you. And for married filing jointly, the rates are 0, 15, and 20%. And the income levels that go along with those, again, for married filing jointly are 0 to $80,000 for 0%, $80,001 to $496,600 at 15%, and that's going to cover probably a lot of people are going to max out at that 15% mark. And then the 20% mark is $496,601 or more, maxes out at 20%. So you can see right there that there is a 17% spread of tax rate between ordinary income and short-term capital gains and long-term capital gains, because short-term capital gains are just taxed at ordinary tax rates for ordinary income rate. And so if you hold something for a very short period of time, like you're trading stock, like the people who recently got into the GameStop short squeeze or AMC, or are in and out of, for example, like Dogcoin or something very quickly, those folks are going to get hit with huge short-term capital gains taxes. Now, that doesn't mean that you shouldn't do it, because they still might have made a ton of money, but Uncle Sam is going to be coming for their piece of the pie, and if those folks made $628,301 or more off of those trades, they are going to be hit with a 37% haircut to their profit versus 20% if they had held those long-term over 1 year. Now, long-term capital gains works very similar to the ordinary income brackets that we spoke about before, in that just because you have $1 that goes up over that amount, it doesn't mean that every dollar is taxed at the 15 or 20% rate. Only those dollars that are above the $80,001 for the 15%, or the $496,601 of the 20%. So if you only have anything under that in, like for example, let's say you made 80,000 or less, that it will all be 0%. If you've made $80,001, only that $1 is going to be taxed at that 15% level, and so on and so forth. There is a very good chance that you could have some pretty significant capital gains and pay 0% capital gains on it. For example, if you are married filing jointly and you and your spouse have $75,100 in income, there is a standard deduction of $25,100. So that is the minimum that you will be able to take off of your taxes in deductions, reducing your AGI to $50,000. And again, this is what all this is based on, is AGI, not your gross income. And then let's say that you purchased a rental home and you've held it for longer than a year, and let's say it cost you $100,000 to purchase it. And this could be representative of anything. It could be a stock that you invested $100,000 in, and now it is worth $130,000, and you want to sell that investment. You are going to end up with a $30,000 capital gain. Your income total with your $75,100 and your $30,000 capital gain minus your standard deduction of $25,100 is going to be $80,000. That's going to put you in, as far as capital gains goes, in that 0% long-term capital gains bracket. So you will pay nothing on that $30,000 capital gain that you have, which is awesome. I've done it before. Earlier in my life, we had some rental property. We sold it for about a $25,000 capital gain, and I just happened to fit in with my income, with the standard deduction that I was able to take and some other deductions related to real estate investing, and I was able to take that gain, and I had split that gain with the partner in my business for investing in real estate, and I paid 0% capital gains on it, and it was super cool to make money and pay no tax on it whatsoever. So let's say that you made about $10,000 more in your ordinary income. So you're at about $85,100, and you still have that same $30,000 taxable gain. When you take those two together, minus your $25,100 standard deduction, you end up with an adjusted gross income of about $90,000. And this is going to illustrate how if you bump up into that next tax bracket, that not every dollar behind it is taxed at that higher level. So in this case, $20,000 of your capital gain will still be taxed at 0%. And $10,000 of that will be taxed at that 15% rate. And so you're still going to get a lot of the benefits of the 0% tax bracket, but you are going to get hit for 15% on any amount over that $80,000 mark. Another massive advantage to investing in things that are taxed at long-term taxable gains rates is that you are only taxed on that when you sell that asset, whatever it is, and incur that capital gain. Versus with your typical ordinary income, your salaries, wages, whatever, you are taxed on that every single year. And so this enables you to have an asset that grows over time to a very large amount of money, and you are only hit with that tax one time when you sell it. Unless there are things like dividends or things of that nature that are paid annually, and if they're qualified, you still only get taxed with this long-term capital gains rate, but if they're non-qualified dividends, you will have to pay ordinary income on it. This is why wealthy folks invest in assets that go up in value over time, such as stocks, real estate, companies, just things that aren't subject to ordinary income tax rates, because that 17% difference between the top ordinary income rate and the top long-term capital gains rate makes for a lot of money if you're earning, for example, $1 million, $10 million, $100 million a year in your total amounts. but it can also work out great for you even if you are, much lower income than that. If you can keep your total income, when you after you take into account the standard deduction that you get under that $80,000 amount, your capital gains will be 0%, and you can make money tax-free, which I know that you guys have all heard that the old adage is that the only things that are inevitable are death and taxes. If you play capital gains right and you have a low enough income, you can avoid taxes altogether. The death part, we haven't found a way around that yet, but we're working on it. So I hope this answers a lot of your all's questions about long-term capital gains and about how assets and investments are taxed over time. If you guys have any more questions on this, please leave them in the comments and I'll follow up and comment on that, or I'll make just a whole nother video if I think it's necessary to get into a video. If you like this content, be sure to hit that thumbs up button for me. It really helps out this video in the YouTube algorithm. If you haven't subscribed yet, be sure to subscribe to grow your wealth, to increase your success, and put you on the road to financial freedom, because that's where we all want to be, where we're not trading our time for money. I appreciate you guys watching, and I'll see you on the next one.